Navigating market turmoil in 2025. The financial turbulence expected in 2025 presents unique challenges for investors. With inflationary pressures, geopolitical instability, and tightening monetary policies, the usual playbook of traditional safe havens and broad market exposure may fall short. This guide delves deeper into constructing a resilient portfolio, highlighting the pitfalls of ETFs in uncertain markets and the merits of diligent stock picking. Why gold remains a core safe haven. Gold's historical role as a hedge against economic instability makes it a cornerstone of defensive investing. 1. Inflation hedge. In periods of persistent inflation, gold maintains its purchasing power, unlike fiat currencies and fixed-income instruments. 2. Crisis shield. Gold acts as a protective asset when systemic risks destabilize financial markets. 3. Liquidity and universality. Its global recognition ensures it remains a liquid and universally accepted asset in any economic environment. Despite its stability, gold is not a growth asset. It should be viewed as insurance within a portfolio, complementing more aggressive growth-oriented investments. The challenges of bonds in 2025. Bonds, once a staple of conservative portfolios, face significant headwinds in 2025. 1. Rising interest rates. As central banks continue tightening monetary policies, bond prices are likely to decline, particularly for long-duration bonds. 2. Inflationary erosion. High inflation diminishes the real value of fixed-income returns, making bonds less attractive compared to other assets. 3. Sovereign risk. Elevated debt-to-GDP ratios in major economies increase the risk of fiscal instability, undermining confidence in government debt. While bonds can still play a role in portfolios, investors should prioritize inflation-protected securities, TIPS, or short-duration bonds to mitigate interest rate risk. The danger of ETF investing in volatile markets. Exchange-traded funds, ETFs, are a popular investment vehicle due to their diversification, liquidity, and cost efficiency. However, in periods of market turmoil, ETFs may pose hidden risks. 1. Overexposure to weak links. ETFs are passively managed and often include underperforming or over-leveraged companies, dragging down overall returns. 2. Market liquidity risks. In high volatility environments, ETF prices may decouple from their underlying net asset values, leading to unpredictable trading outcomes. 3. Sector concentration. Many thematic or sector-specific ETFs inadvertently overweight certain industries or large-cap stocks, increasing exposure to market-wide drawdowns. 4. False sense of security. ETFs encourage a set-it-and-forget-it mindset, which can be dangerous when proactive adjustments are needed during a crisis. While ETFs are a useful tool for diversification, their structure makes them less flexible during market downturns. The case for stock picking. Stock picking, when done with rigorous due diligence, can mitigate the risks inherent in passive investing while unlocking growth opportunities. Why stock picking excels in turbulent times. Selective exposure. Investors can avoid weaker companies and focus on fundamentally sound businesses. Downside protection. By analyzing balance sheets, cash flow, and management quality, investors can select companies capable of weathering economic storms. Tailored strategies. Stock picking allows for targeted exposure to specific industries, trends, or geographies without being constrained by ETF composition. Undervalued opportunities. Market volatility often creates mispriced opportunities, enabling savvy investors to acquire quality businesses at a discount. What to look for in stock picking. Financial strength. Focus on companies with low debt-to-equity ratios, robust free cash flow, and sufficient liquidity to navigate tough conditions. Management quality. Leadership teams with a history of prudent capital allocation and adaptability during downturns are critical. Secular tailwinds. Target businesses aligned with long-term growth trends such as green energy, AI, and digital infrastructure. Valuation discipline. Avoid overpaying by comparing current prices to intrinsic value, supported by solid earnings and growth potential. Why emerging technology micro and small caps are promising. Emerging technology companies are uniquely positioned to thrive during periods of economic uncertainty. Their agility, innovation, and focus on high-growth niches make them resilient and potentially lucrative investments. 1. Counter-cyclicality. Many emerging tech firms solve essential problems such as cost optimization, data security, and operational efficiency, making their solutions indispensable even in recessions. 2. Market disruption. These companies often operate in markets ripe for disruption, capturing demand while larger firms struggle to adapt. 3. Scalable growth. Early-stage technology firms benefit from scalable business models, allowing them to achieve outsized growth relative to their size. 4. Undervalued niches. Market volatility can unfairly penalize these companies, presenting opportunities to buy into innovative sectors at discounted prices. Constructing a resilient portfolio for 2025. 1. Gold as a defensive core. Allocate 5 to 10% of your portfolio to gold through a mix of physical assets, ETFs, or mining stocks. 2. Bonds with a cautious approach. Limit bond exposure to short-duration treasuries or TIPS to protect against interest rate risk and inflation erosion. 3. Focused stock picking. Build a portfolio of carefully selected businesses with strong financials, skilled management, and alignment with secular trends. Avoid overexposure to single industries or speculative bets. 4. Small cap and microcap exposure. Dedicate a portion of your portfolio to emerging tech companies. Conduct detailed due diligence to identify financially stable firms with innovative solutions and high growth potential. 5. Diversified alternatives. Consider diversifying further with dividend-paying stocks in defensive sectors, real estate investments in essential services, and infrastructure projects benefiting from government stimulus. In 2025, the investment landscape is complex, but it also presents significant opportunities for those willing to look beyond traditional approaches. While gold and bonds provide defensive options, they may not fully address the challenges posed by inflation, rising interest rates, and systemic risks. Stock picking, combined with strategic exposure to emerging technologies, allows investors to build a portfolio tailored for resilience and growth. By prioritizing financial strength, innovation, and alignment with macroeconomic trends, investors can navigate market turmoil and emerge stronger on the other side. The key to success lies in preparation, discipline, and the courage to invest where the opportunities align with the future.